All right, so it's time to start now. Oh, it's still screen share loading. Wait a second. There we go. So tonight we are actually for the first time going to use some Excel. So if you go into Brightspace, you'll see that in chapter 7, let's see, here it is. You have, besides the class notes, you've got something called Excel template. So if you open that up, you'll see there's a spreadsheet with a lot of information in it, but what I've done is I've set it up so that we don't have to spend a lot of time typing in data, and then we can focus our attention on doing the actual problems. And we're going to see how to calculate bond prices and the yields of bonds. And if you don't have a whole lot of Excel background, it doesn't matter. This will be very straightforward. If you do, you might be learning some new things that you haven't seen before, because Excel is one of those things where you never stop learning. All right. There's so much in there that you could spend your whole life studying Excel. So the other thing too is that this week we actually have a short Excel assignment here. And so the details of this document, chapter 7 is done. And so actually, it's not even a document, it's a spreadsheet. And it's set up so that you can tell what you're supposed to do, because the yellow is where you're supposed to enter information. So in other words, you'll see, and we'll do a lot of these examples tonight. You'll have data for each of these different bonds, and what you're going to do is calculate the cash flows for the bond, and you're going to calculate the bond's price. Okay. And so we're going to do that with several different types of bonds. And so it won't be that difficult, especially after what we're doing tonight. But I just wanted you to get some hands-on practice pricing bonds in Excel, because if you do this in practice, I mean, if you're working on a job where you need to do this, you're not going to do it with a calculator. Let's put it that way. It'll certainly be done in Excel or possibly some other software package. So when we're through practicing with this template, you'll have no trouble at all completing this assignment. So it'll be fun. Okay, so anyway, let's get back and remind ourselves what we were doing. We just barely started this last time. You remember the chapter 6 was a discussion about money markets, which are short-term debt instruments. Bonds are longer-term debt instruments. They usually have a maturity of several years, and they can go out to 30 years, sometimes even 40 years. But what really separates them from the money markets is the fact that they have such long maturities. And the money markets, usually most of those securities are actually very, very safe. They have very little credit risk. With bonds, anything goes. You know, some of these bonds in the market are very, very safe. Some of them are very, very risky, and you have everything else in between. So the bond markets are actually where corporations raise a very large percentage of their capital. Most of it comes from either, of course, as you can imagine, equity or stocks, and debt, which is bonds. Although they can, of course, raise money from other sources. They can get money from banks, let's say, or private investors. But corporations usually raise their funds from either stocks or bonds. All right. Now, it turns out that the dollar value of all the bond markets in the world, it may not seem like it, is actually larger than the value of all the stock markets in the world. In other words, there's more debt floating around out there than equity. They're both extremely large markets. So what we want to do is understand the basic features of bonds and the different types of bonds that are available in the marketplace, and even try to get a sense of why you would want to buy one as an investor. And as a corporation, why would you want to issue one instead of issuing stock? Okay, so it's a very big area of study. And it's what's interesting about bonds is that, unlike stocks, bonds can be analyzed with a lot of math. Okay, that's because their cash flow structures are very predictable compared to stocks. And so with stocks, you tend to analyze them based on financial statements. And so there isn't a whole lot of math as such. But here, the bond markets do involve quite a bit of math. In fact, the people who work in this area often tend to be people with very strong math skills, because it does require some fairly complicated techniques to adequately price a bond and determine what kind of risk is involved in owning a bond. So this is much more quantitative than what you would see with stock market analysis. Anyway, so just quickly remind ourselves some of the key features of bonds that we were looking at last time. A bond is a debt instrument, which means it's a security in which you are basically lending money to the bond issuer. If you're an investor who owns bonds, you have lent money to somebody, and in exchange for that, you're expecting to get regular interest payments and eventual repayment of the amount you lent them. So bonds have a contract that is associated with them called an indenture, which lays out all the terms and conditions. And so what kinds of terms and conditions do you need to know? Well, first of all, the face or par value, which is the price at which it is issued. You don't get this with stocks. They don't have a face value as such. With bonds, typically the face value in the United States, at least, is $1,000, or possibly a multiple of that, like 10,000 or $100,000, or even a million. But usually $1,000 is the face value, and that means when the bond is first issued, the price is $1,000, let's say. Now that can fluctuate over time, as we'll see here. But when the bond matures, whoever owns it at that time is going to get the $1,000. It's a loan. It's basically a loan of $1,000 to the bond issuer, and then in exchange for that, you also will receive periodic interest payments. Okay, but the price of the bond itself is only going to be $1,000, or the face value, on the day that it's issued and the day that it matures. Every day in between, it can have a different price. Okay, and as we'll see when we go into these examples, when interest rates in the marketplace fluctuate, so do the prices of these bonds in the opposite direction. Okay, so in other words, if interest rates in the economy are drifting up, that means bond prices are going in the opposite direction. They're falling, and vice versa. So they always go in opposite directions. Now, the coupon is the interest payment that you'll receive from the bond. The coupon rate tells you what percentage of the face value it represents. So if you're buying $1,000 face value bond, for example, with an 8% coupon rate, that implies an $80 coupon that you'll be receiving. Although in the United States, at least, instead of getting $80 once a year, it's normal, much more normal, to get two semi-annual payments of $40 each. So I think we may have already done this before, looked at a bond certificate from ancient times when we didn't have any computers. Now, of course, you're probably aware that before computers came along, stocks and bonds were sold in form of certificates. In other words, you could prove that you owned a stock or a bond with one of these certificates. And these bond, and by the way, if you're interested in this, these certificates were designed to be impressive. They really were works of art. So, and that's what you want people to think the corporation is doing very well. And I noticed with Google, sometimes I ask for bond certificates and it gives me stock certificates. But here's one. Yeah, this would be stock in the Pennsylvania Railroad Company, but this is an actual bond issued by the United States government. It says $1,000 on there, although it's very fuzzy. It's going to be hard to read it, but you can just about make out the 7.5% up here. So that means that with the face value of $1,000, whoever owns this bond is entitled to receive a coupon of $75 a year, or more likely $37.50 twice a year. That never changes, by the way. The only thing that can change with a bond is the actual market price. That can fluctuate every single day, but the other terms and conditions, the coupon rate, the coupon, the face value, the maturity, those are locked into place. They cannot change. All right, so yeah, there's some in here, but anyway, now sadly enough, now there used to be a museum in New York City in the Wall Street district called the Museum of American Finance, and they had a lot of really nice examples of historical stock and bond certificates, among other things. They also had a lot of historical U.S. notes and coins, and they had all kinds of fun things down there. Unfortunately, the building was damaged by flooding. And I guess for whatever reason, the museum was never able to find another place to move into. I guess the rents are just too high in that neighborhood. So I don't know what's ever going to happen to it, if it ever will open its doors again. But while it lasted, it was a nice place to visit and learn more about U.S. financial history. They had a lot of interesting stuff in there. In fact, they actually had a bond that was signed by George Washington. They all kinds of these things. Like it was unbelievable what they had in there, and yet I guess they're still looking for a place that they can afford to move into. It had the place they had, it was an old bank, one of those really old style banks from the very beginning of the 20th century, where it was meant to be very ornate, very impressive looking to people. The stairs were made, everything was made of marble. They had spiral stairs leading up to the second floor, and it was a beautiful building. It's just so sad. I mean, but anyway, I mean, that was part of the experience, the actual building itself, because it was pretty obvious that it had previously been a bank back in the day when banks were meant to be beautiful, not sterile like they are now. But anyway, the coupon is the dollar that the investors are going to collect. The maturity is the time until you will actually receive your face value back. So in other words, this tells you how long you'll be collecting interest payments for. And for the most part, corporate bonds tend to be issued in maturities of 10, 20, or 30 years because they're meant to be long-term investments. But we know in the treasury market, you can have anything you want all the way down to 1 month. And we already started to talk about call provisions. Corporate bonds typically are callable, as it's called, meaning that if interest rates fall off significantly, the issuer of the bond rather, reserves the right to recall it so that they can reissue it with a lower coupon rate. So, when you buy one of these bonds, you have to be aware of this so that you know that if rates are falling, there's a chance your bond could get called back. So it's very disadvantageous to the investors, but they do get compensated for this with a higher coupon rate. So it can work out for the best, but it can be a huge problem too. The put provision, if it has one, means that it's the other way around. The owner can sell it back to the issuer if rates are going up and they want to try to buy another bond with a higher coupon rate. And then, of course, some bonds can have both calls and puts embedded in them. It can get very, very complicated very quickly. Sinking funds are when the corporation, this would normally not happen with treasuries. Treasuries usually have very few special features built into them. That's because it reduces their attractiveness to investors. And the government needs to raise money. They need to borrow money. So they have to make the bonds as convenient as possible. And so that's why they tend to shy away from these types of special features. Whereas, corporations are doing this because they think that they can use your money to improve their profits. So, they can feel free to put special provisions in here that work to their advantage if they think they can still sell their bonds to the public, because they're ultimately hoping to make money by issuing bonds and using the proceeds to invest in developing new products or expanding into overseas markets or whatever the case may be. Okay, and convertible bonds are the ones that can be traded for stocks. You don't see, it's not a huge percentage of the bonds in the market that allow you to do this, but it's an interesting idea. The idea that you have the right, anytime you get tired of getting just coupon payments, to say, listen, I want to trade this in for stocks. I want to share in the company's profits. But then you have to be prepared to pay for this. In other words, either you'll have to pay a higher price for it, or you have to accept a lower coupon in exchange for this privilege. Okay. So it's an option that you've been granted. And so you have to expect to pay for an option. Now, who issues bonds in the United States, as we briefly discussed, the Treasury Department, government agencies like Fannie Mae and Freddie Mac. Corporate bonds, corporations issue enormous quantities of bonds every year to run their businesses. Municipal bonds are issued by city, state, and local governments, usually for local projects, like roads and bridges and schools and hospitals and things like that. And then foreign bonds issued by either foreign governments or foreign corporations. Those can actually be denominated in either dollars or the currency of the issuing country. But, there's good things and bad things about both of those from the perspective of the investor and the borrower, rather. But most bonds issued in the United States would tend to be denominated in dollars. Now, as we already have seen, treasury bonds are issued for one purpose only. If the government didn't have any deficits, there wouldn't be any treasury bonds. There would be no need for them. They don't do this because they enjoy borrowing money. It's because they have to. They've run up deficits every year, and they have to pay for them. So they're in a unique position though. Unlike corporations that can go bankrupt, the government can't go out of business. But unlike a corporation, they can also raise taxes. Okay, so if they're running out of money, they can raise taxes and make sure that you'll get the interest you've been promised. Because the only reason people own these things is because they're so confident that they'll get their cash flows that they've been promised. As soon as they start having doubts about that, then this market would be in a lot of trouble because people are buying treasuries and getting very low rates of return in exchange for the safety. So in other words, retirees often will buy these because they can't take any chances. You might have corporations or like special certain types of corporations, like let's say pension funds or insurance companies. They can't be messing around. They can't be buying stocks, risky stocks at least. So they'll probably invest some of their funds in treasury securities. They want to, get some kind of revenue, but they can't be running out of money either. And also foreign central banks own a lot of treasury securities. Both the Bank of China and Japan each own more than $1 trillion of US treasuries. Okay, it's a safe investment. And so that's how they see it. And I think we mentioned this too, that the naming conventions are in the treasury market. The securities that have a maturity from a month to a year are called treasury bills. The notes run from 2 to 10 years, and the bonds run from 20 to 30 years. That's all we have. Okay. And you can be sure that these maturities only exist because people want them. The government knows from experience which maturities are the most popular ones, and they make sure that they keep them. There are some maturities that don't exist any longer because people just didn't want them. Agency bonds, I think I mentioned that Fannie Mae is the unofficial name of the Federal National Mortgage Association. Freddie Mac is the actual unofficial name of the Federal Home Loan Mortgage Association. What do these agencies do? They buy up mortgages from the banks. Okay, so imagine you're a bank, you just lend $1 million to a customer for a mortgage, and another opportunity comes your way, and you're like, oh my God, what did we do? Why did we make this mortgage? We can do even better with this new opportunity. Well, they're not stuck with your mortgage forever. They can sell your mortgage to one of these agencies, which frees up all that money, and then they can do whatever they want with that money. Now, the homeowner doesn't have to know anything about this. They might tell them, but they don't have to. As long as, see, the thing is, though, the banks that issue or sell their mortgages to Fannie and Freddie, they'll still be the ones who collect the checks and who do all the processing. And in exchange for that, even though they don't own the mortgages any longer, they'll continue to collect what's called a servicing fee from Fannie and Freddie. It's going to be some small amount, like 0.25%. And so that goes into their pocket. So they're still earning some money, but the majority of it is now available for them to do something else with it. So it provides liquidity to the mortgage markets and makes it easier for banks to provide mortgages to people. The logic behind setting these up is that it presumably makes it easier for people to buy houses. And the system worked well until Fannie and Freddie got involved with buying subprime mortgages, and then that's when all hell broke loose. You might want to watch that movie of The Big Short to get more details about that. But as long as the mortgages themselves were very safe, this was a good setup because it meant that the banks had more liquidity available. It also meant investors had something else to choose from. Investors had the ability, and they still do, to buy a security known as a mortgage-backed security, which is a share in a pool of mortgages. Okay, so if the mortgages are safe, you've got a very safe investment, which is giving you a pretty high rate of return compared to other safe investments. And the only thing you had to worry about was if the investors, the homeowners rather, prepaid their mortgages, then that would reduce your income stream. But there was very little credit risk until, the early 2000s, when suddenly banks were lending money to anybody who walked in the door, and then these mortgages were getting sold to these government agencies, and then securities were being created, backed up by these awful subprime mortgages. And so let's just say that when the whole thing collapsed, it was ugly. Anyway, now we do have these things. Now, this is an interesting twist. The notion of this of strips. So let me show you what this is all about. We'll see more of this later on when we start pricing bonds with our Excel spreadsheets. So here's the situation. We know that, let me just save this thing real fast. What's today, the 5th? Okay, so as we saw earlier, Treasury bills are sold or have a maturity of up to a year. But and the other two, as we've already seen, Treasury notes have a maturity of 2 to 10 years. Treasury bonds have a maturity of 20 to 30 years. But there's one more thing that really separates these three types of Treasury securities. Treasury notes and bonds pay coupons to investors. In other words, twice a year, you get half of the annual coupon rate sent to you, or credited to your account, actually. Treasury bills, though, are sold at a discount from the face value, then redeemed at the full face value. So, for example, an investor might pay $950 for a $1,000 1-year Treasury bill. And that means that they'll pay $950 now and receives $1,000 in 1 year. Not bad. I mean, well, that's kind of high by today's standards, but the return to the investor is 50 over 950. In other words, the cash flow divided by the amount you paid for it. And so that works out to about 5.26%. Now, here's the interesting part. Since Treasury securities are free of credit risk, this is a guaranteed rate of return. So you're probably saying, well, isn't that true for the notes and bonds? Well, with Treasury notes and bonds, the rate of return to the investors is affected by the return that they can get by reinvesting the coupon payments. Now, that's something that nobody can figure out in advance what's going to happen. In other words, you collect a $30 coupon, let's say, from a Treasury security. Who knows what future interest rates will look like? We don't know if we're going to get a high rate of return from those coupons or a low rate of return, or who knows, maybe we'll just spend the money. So these bonds expose investors to a special type of risk, reinvestment risk. This is the risk that the return to future will be very, which will reduce total rate of return to the investor. So in other words, you're worried that if you have these coupons coming in and rates fall in the future, that means your future cash flows will be reinvested at a relatively low rate of interest, and that will impact on your total return. So treasury bills don't have any coupons. And so therefore, not subject to reinvestment risk. Now, suppose you're an investor and you say to yourself, that sounds very attractive to me. I wish I could buy a 10-year treasury note that was sold at a discount from face value. That would be perfect because I have a 10-year investment horizon and I don't want to worry about reinvestment income. So, oh, if only I could find such a security in the marketplace. But it doesn't exist. So somewhere along the way in the early mid 80s, Wall Street dealers got together and said, our customers want long-term, risk-free, zero coupon bonds, but they don't exist. The Treasury doesn't issue them. It only goes out 1 year. What can we do to make money and help our clients and make money? All right, in that order, make money, and by the way, help the clients too. Okay, so here's what they came up with. It's a very clever idea. They said, well, listen, now these are all the primary government bond dealers. They're constantly buying treasuries directly from the government and then selling them to their own customers. So they always have an inventory of treasuries at any given time. So imagine that one of these bond dealers has this bond in their inventory. And in 10 years, it's scheduled to make a coupon payment of $1,000, just to keep it simple. So the financial institution owns this treasury bond, and they know that in 10 years it's going to make a coupon payment of $1,000. So here's what they came up with. The financial institution sell the rights to this coupon to an investor at a discounted price. So in other words, imagine they say to their client, for example, Goldman Sachs can offer to sell coupon to a client for, now this is a 10-year investment. So let me just make up some numbers here real fast. $613.91. Okay, so then the investor buys this thing in 10 years. The investor will receive $1,000 for a capital gain of $386.9. The rate of return will be so this is for 10 years, by the way. What you're seeing here, 386.09 over 613.91. Six. What did I do here? Nope, sorry. No, that's right. It's 62.89%. But on an annual basis, though, that works out to exactly 5%. Now, here's the genius of this. That 5% is locked in. It doesn't matter. I don't have any coupons to reinvest. It doesn't matter what the future direction of interest rates is. This is a done deal. It's guaranteed. And here's an even better aspect to all this. Even if this financial institution goes out of business, the Treasury has a record of this bond and it knows that this payment belongs to this particular investor. So that means there's no credit risk either. So a security like this, a zero, let's say a zero bond created from the cash flows of existing Treasury security is known as a strip. Now, strip stands for separate trading of registered interest and principal securities. Okay. Now, once the first company started issuing these or offering them, this market is extremely popular. And the way it works is that investors can buy strips with maturities out to 30 years in increments of 3 months. In other words, you could buy one that has a maturity of 25 years and 3 months if there's some reason why you want that, or 18 years and 6 months. So they're all out there. Now, the Wall Street Journal used to publish a list of these strips prices. Then they kind of got out of it. Let me see if I can find that real fast, because I do subscribe to the Wall Street Journal. Oh, I can tell this is not going well. No, you know what? No, these are regular treasuries. This is not the strips market. These are all the ones that are outstanding. No, I don't know why they stopped publishing them. No. All right, but you know what would have happened is you would have seen, like, let's say the first one would have been, July 1st. You would see a quote like this, July 1st, and it would have had a price, which is actually a discount factor, like 0.9872 or something like that. And that would have meant that, let's say $1,000 strip maturing on July 1st, 2025 would cost, you multiply the 1,000 times the 0.9872. And so that's how you would know. So in other words, the prices are actually what we call discount factors. They're fractions of one, which tell you what percentage of the face value you have to pay to buy this thing. And then you know that on the maturity date that's listed there, you're going to get your full $1,000 back. And so these are a type of zero coupon bond that were synthetically created from existing treasuries, but they're not issued by the Treasury Department itself. Financial institutions are the ones who create these things for their clients. Now, of course, they're charging a fee in here somewhere too. I mean, they're not doing this just for the fun of it. But the strips market came about in the early 80s, mid 80s, I'm going to say, maybe 1985. Now, what's interesting is that once this market came into being, this is when the Treasury stopped issuing bonds with all these bizarre features, because they just found out that those features, especially the call feature, made it awkward for the strips market. Because imagine if these bonds could be called away, then the financial institutions can't be guaranteed that they're going to get these cash flows to be passed along to their clients. So this helped increase the demand for Treasury securities. So the Treasury felt like, all right, that's fine. If this makes us more popular, then we're going to go along with it. Okay, so Strips are meant for people who want to not deal with coupon payments. You can have a much longer investment without having any reinvestment risk. And they're very, very popular. It's a huge, huge market. But it doesn't exist itself. In other words, the Treasury doesn't issue these things. They're being created synthetically from existing Treasury securities. Now, so that's what the strips market is. Now they also have this thing which it would, it's inflation usually isn't very high in the United States, so this is not such an important thing, but they do have these things called tips. And the point of a tip is that instead of saying, well, here's your coupon rate, what it does, the investor is guaranteed a specified real or inflation adjusted rate of return. So in other words, it has a coupon. For example, a tip with $1,000 face value offers a coupon of 2% and guarantees a real return of, let's say, 4.5%. If inflation rises unexpectedly, the Treasury increases the principal value or the face value of the tip so that the combination of coupon payment and the capital gain adds up to the guaranteed real rate of return. So in other words, you can imagine this would be very popular with people who are retired because they're saying, listen, I don't want to be fooling around buying treasuries and not knowing what the future rate of inflation is. This way I'm guaranteed a certain real rate of return. And so that makes me comfortable. And this is something else that's even, I think, newer than strips. I'm not sure when tips came into being. Let's see if I can check this out. I'm sure Wikipedia has a history of both of these. Oh my God, the 60s. Well, that might be true, but I think they didn't really catch on until the 80s. Strips are bonds that had interest payments stripped away and sold separately. The principal is still paid at maturity. The U.S. government does not issue strips directly to investors. They're created by financial institutions who are basically using their own inventories. There's probably an ad here and I can't get rid of it. Usually there's a little extra, but anyway, who purchase conventional treasury securities, then instruct the interest payments away to be sold as separate securities with separate use orders. They're sold back with full faith and credit of the U.S. government, even though they split up. So, yeah, so this is a good example. Treasury issues a 30-year bond with 3.5% coupon rate. So let's say you buy your government biller and you own $100 million of these. Over the next 30 years, you're going to collect 60 annual payments of 3.5 million each. And then those can be sold at a discount to investors. Okay. So what about case. '97, yeah, I knew that was much more recent. And again, they're trying to appeal to a different segment of the market. They suspected that there were a lot of people who would buy these if only they existed. So the point of it is that the uh, principal is adjusted, not the coupon, but the principal, so that no matter what happens to the inflation rate, you're going to get the same real rate of return. By the way, it can go both directions. If your principal can be reduced if inflation is very, very low. But anyway, so these are just some of the main types of securities that are available in the marketplace. So here's an example. You got a coupon rate of 3%, but inflation is 4. So in order to make sure that you get the right real rate of return, in principal is adjusted to 1040, then the coupon is 3120. So if you take 3120 and divide by 1 plus the inflation rate, it brings us back to $30. So it guarantees that you're still getting, no matter what happens, the inflation rate, a 3% real rate of return. Now, savings bonds, we all know what they are. They're meant for small savers, for long-term savings. Corporate bonds. Of course, we know that corporations issue a large amount of bonds to raise funds. Now, some corporations have a lot more debt than others. Now, also some corporations, after they've issued stocks for the first time, they never issue any new shares of stock because they don't want to dilute the ownership of the corporation. So there's a lot of important advantages and disadvantages to raising funds with stocks and bonds for a corporation. So, all right, so let's see. For equity, which means stocks, corporation does not have to make any payments to the investor, but the ownership is now spread out among a larger number of owners because the shareholders are owners. That's what it means. Right? That's why the word equity is used because equity means you actually own a piece of the company. It's equity. Okay. So the good thing is we don't have to make any payments to the investors, but that means we have to share the wealth with more people. For bonds, the corporation does not dilute the ownership, but is required to make all promised payments on time or risk bankruptcy. Okay, so that's the big thing. If let's say you're having a rough year, you owe all this money, you can't pay it, you could in principle be hauled into bankruptcy court. At the very least, it's going to be a problem because the stock will fall. People won't want to do business with you. So anyway, so that's the risky thing for the corporation, but there's a couple of good things here though. Um, from the corporation's perspective though, issuing debt is usually cheaper than issuing equity. And on top of that, all coupon payments are tax deductible. To the corporation. All right. Dividend payments to shareholders are not. So there's a lot of good things, and that's one of the reasons why many corporations raise most of their capital. Not all of it usually, but all of their most of their capital from bonds. Yeah, and you could look it up. You could go to Yahoo.finance and you can find out what proportion each corporation has raised their funds from each source. They publish something called the debt to equity ratio, can be used to determine what proportion of a corporation's capital is from comes from debt and equity. Okay. Now, of course, we already know that one of the big problems with the corporate debt is that it exposes investors to default risk, meaning you don't know that you're going to get all your money back. Even Apple could potentially go out of business if you give it enough time, but it's not likely, but it's possible. And so you need to look at these credit ratings by Standard & Poor's and Moody's to make sure you're not getting into something that's too risky for you. Municipal bonds are usually only invested in by very high net worth individuals because they tend to pay very low coupon payments, but they also offer extremely advantageous tax treatment that you don't get with other types of bonds. So that's who tends to buy these. And so these are, like I said, issued by city, state, and local governments. The purpose is to raise money for local projects, right? So the state of New York needs to fix the roads. Well, where do they get the money? This is one possibility. All right. Now these have credit risk though. You wouldn't think so, but a city can go out of business. Well, it can't go out of business, but it can go bankrupt. Like the city of Detroit in 2013, or the city of New York in 1976. It does happen occasionally. Now, even then, usually what happens is the debts are negotiated with the owners of the bonds so that, they might try to stretch out the payments, they might try to reduce the size of them. Bankruptcy is different because if a corporation goes bankrupt, the bankruptcy court sells off all of the company's assets, and whatever there is split up among the bondholders, and that could be very little in some cases. So here, at least, there's some chance you'll get some of your money back, just not when you're expecting it. And of course, foreign bonds, we do know that foreign companies and foreign governments do issue in the United States. Um, Now, we're finally going to get a chance to see how bonds are priced in the marketplace. Like if you look in the Wall Street Journal, for example, at a bond price, suppose you looked and you saw this quote, Apple, and it would specify usually the coupon 3%, 28.55 or something, because it's a 30-year bond. And then you see this price 101.54. What does that mean? So these prices in the Wall Street Journal and other sources are going to be based in terms of 100. This means that a $1,000 face value of a bond will actually cost the investor 101.54% of the face value of 1,000, which means 1,001 $15.40. Okay, so you multiply 101.54 times 10, you'll see that it's 10, 15, 40. Now, why do they do that? Because that way, this approach works no matter what the face value of the bond is. In other words, if the bond was $10,000, then the market price would be 10,000. And 1,540. So you can figure it out from your knowledge of this price and the face value of the bond, what the actual market price of the bond is. So now, where did that come from? Where did that number, how do we know? Well, the bottom line is a bond's price equals the present value. And this is a key concept. We'll review this in a second. of its future cash flows. So we're going to take a little detour and explain briefly what present value means. Present value of a dollar is the amount that would need to be saved today to be worth a dollar at some point in the future. Which is a quick example of, suppose that an investor in our 5% bank account he needs to have, let's say, $10,000 in the bank in 5 years, make a down payment on a house. How much must he put in the bank today to meet his goal? Now, making the assumption that interest is only credited to our account once a year, what you're actually going to do is take the $10,000 and divide it by 1 plus the rate of interest. And the exponent will be 5 because it's a 5-year investment. Okay, so let's see what that is. $78.35.26, rounding it to dollars and cents. So if I put that much in the bank now, in 5 years, it'll be worth $10,000. So that means that 78 is the present value of $10,000. Hold on. Received in 5 years with an interest rate of 5%. So that means that in principle, if let's say somebody owed you money, all right, somebody owes you, and you say, listen, they say, well, here's what we're going to do. I can give you $10,000 in 5 years, or I can give you 78.35.26 now. In principle, you should be indifferent between the two because it amounts to the same thing. Assuming, of course, that you're going to put the money in the bank for 5 years at a rate of 5% per year, it amounts to the same thing. So the smaller amount, the 78.35.26, is the present value of the larger amount. And in turn, we can say that $10,000 is the future value of 78.35 invested today, 5 years, at a 5% rate of interest. Now, if the interest is paid credit to your account more often, we can make the necessary adjustment. We could turn this into, let's say, a monthly rate of interest and turn this exponent into months. But the bottom line is, this is the simplest way to calculate present value. It's all about how much is a dollar in the future worth today. Okay, so the bond's price is calculated in the same way, except that you've got all these coupon payments coming along. And so you're going to ultimately end up calculating the present value of those coupons and adding them up. So in our slides, we have a bond that's issued with $1,000 face value. The coupon rate is 4%, which means the annual coupon is $40, and it matures in 4 years. What kind of cash flows is the investor going to receive? Well, let me draw this in here. Let's use a timeline for this. The little t's are time in the future, except for 0, which is today. clean that up a bit. So in 1 year, in this example, the investor will get a $40 coupon, and then at the end of year 2, 3, and 4. But in the last year, they also get $1,000 back. So those are the cash flows that we're entitled to receive in the next 4 years. Now, the price of the bond is the present value of these cash flows. Now, we're going to have to make an assumption about the appropriate interest rate to use here to discount these cash flows. And that interest rate is known as the bond's yield to maturity. This depends on many factors, such as the maturity of the bond, the level of interest rates in the economy, the credit risk of the corporation or the issuer. Okay, so now you can look it up in the Wall Street Journal. For any corporation, their yield should be listed there. But in this example, we're going to assume 4%. Oh, wait a minute. Maybe not. All right, I'll tell you what, I'll do it right now. All right, so we're going to use the Excel in a minute anyway. Um, in this example, bond has 4 years to maturity. The annual payment is $40. If the yield to maturity is 4%, bond's price will be. Again, given the cash flows that we have, here's how you would calculate it. So in other words, the 4% is the yield, the bond's yield, and the exponent is the number of years in the future in which I receive that cash flow. Now, you could take this out, take your calculator out and figure this out, but I'll just tell you to keep things simple. Or actually, let me just do it real fast on my calculator. But in a few minutes, we're going to do this in Excel. All right, so rounding to dollars and cents, we have all right. The next one is 36.98. The third one is 35.56. And then 889. That's close enough. All right, and if you add these up, you'll get your price, 38.46. 36.98. Oops. 35.56. And the last one is 8.89, and that adds up to $1,000. What do you know? How do you like that? So now this is a special case because if you notice, the coupon rate and the yield to maturity are equal to each other. When this happens, bond's price will always match the, um, the face value. Now, suppose that the yield rises to 5%. What happens to the bond's price? Well, what we're going to end up with is oh, sorry, that one's a 5. Now, even without knowing what the number is, you can see that the denominators are larger than they were in the previous example. So since the denominators of these terms have risen, the ratios will fall, the price will fall. Okay. Now, I'll tell you, let me just quickly do this for you. And then I'll show you how to do this in Excel. This is what I've been building up to. We're going to get to do this exact same type of calculation in Excel, but I can just quickly type this into my calculator and let you know what the new price is. So it's, what is that, 4 years or 5% yield. The coupon is 40, the face value is 1,000. That means the price is now 964.54. And now finally, if the yield falls to 3%, the new price will be, and of course it has to be higher because the denominators have fallen. And so that's going to change it to 1037.17. And it's just algebra, straight ahead algebra. So the bottom line is, and this is a very important result, there is an inverse relationship between yields and bond prices. Okay, so if interest rates in the economy go up, yields will rise, bond yields will rise as well, and bond prices will fall. But on the other hand, of course, if interest rates fall, yields will fall as well, and bond prices will rise. So you're going the other direction. Prices and yields always go in opposite directions. That's one of the most fundamental principles in all of finance, by the way. And now we're going to check this out with our first example in Excel. If you open that thing up, under the tab bond pricing, you'll see, well, it just happens to be the same bond. And you'll notice that across the top, we have yields of 4, 5, and 3%. And now we already know what the answers are, but we're going to do this. We're going to calculate the present values of the individual cash flows and add them up. Okay. So here's how you'll do it. You can go to the cell. Let me just make this bigger so you can actually read it. equals cash flow divided by 1 plus. The yield is on top in cell C1, but I'm going to do something special here. I'm going to put dollar signs there to indicate I do not want that reference to ever change. It's a constant. I want to leave it there. So I'm going to call it with dollar sign C1, the exponent will be the year in which I received the cash flow. That's going to give me the present value, which you've already seen. It was $38 and some odd cents. Right. Okay. And now, because here's the genius of Excel, because it's been set up correctly, I can just now drag these down without retyping them all. And now I can add these up by hitting sum. And we're all set. Now, I think let's see, I forgot what function I'm referring to. Hold on 1 second. I just want to double check something here. Chapter 7. Oh, I see what I meant. Okay. All right. I was wondering what I was trying to do there. Um, there's a function built into Excel that will make it unnecessary to calculate each individual present value as long as there's a pattern there. And that function is called PV. And if you look here in this tiny little ribbon here, it's asking you for the rate, which by which they mean the yield. The number of periods, the number of years is 4. The coupon payment is 40. The face value, you'll have to type this in yourself. It's 1,000. Now, if you notice, it's giving us a negative because they're assuming that this is coming out of your pocket. If you want to avoid that, you can type a negative in front of this command. So it's got different format, but this is the function. There it is, that you can use to avoid the need to calculate the present value of each individual cash flow. They're, of course, giving us the same answer. I don't know why the formatting is different, but they're both going to give us $1,000. Okay. Now, what happens? Let's come over here and see what happens if I raise the yield to 5%. Well, the present value formula is the same. It's the cash flow divided by 1 plus the yield, which I need dollar signs to prevent it from changing. The exponent is the year in which I received the cash flows. And that's going to be, if you notice, with a higher yield, the present values are lower. And if they're all individually lower, then of course it stands to reason that the price is also going to be lower. Yeah, quite a bit. It went down by over $35. And if you want to use Excel's built-in PV function, we'll make it negative. The rate is here. Number of periods is here. The payment size is here. And then the $1,000 is last. Yeah. And of course they agree with each other, except for the rounding. By the way, if this is driving you crazy, you can change the formatting by hitting this little format painter, as it's called, to make sure that they're the same. I'm going to do that right now, so it looks nicer. Now, the last case I want to consider is the lower yield. And you can see that I've got J4 is the cash flow divided by 1 plus the yield. The exponent is the year in which I received the cash flow. Right, so I drag this down. Add these up, and we already know that it's going to go up. 1037.17 approximately. The Excel function will look like this. The rate is here. Number of periods, payment, and face value is 1,000. And that's my price. Now, if I were to continue doing this with all kinds of different yields, 3, 2, 5, 8, you name it, eventually I could put together this special graph. Price is here, yield is here. So this is the same bond. If you recalculate the price with all these, and based on all these different yields, you're going to have a very special type of relationship that looks something like this. And this is called the price yield curve. Now, the way I've drawn it, it's a little bit exaggerated. It's not maybe quite that curve. Maybe I'll just tighten that up a bit. That's probably better. Okay, so what we notice here is that this price yield curve has a negative slope. Since prices and yields move in opposite directions. But if you notice, it's not a straight line either. It's curved in a very special way. The shape of this curve is said to be convex. It's not a linear function. And this actually works to the advantage of the investors. This means that the fall in price when yields drop, when yields rise rather, is less than the gain in price when yields fall. So there's an imbalance in favor of investors. The curve is responsible for that. If it were a straight line, then, if you notice, for example, here, I'll show you what I mean. In fact, I'll tell you what, let me summarize what we just did. So you can see it better. So 3 is this one. 4 is this one, way over on the left. And then 5 is this one. So I'd like to point your attention to the fact that starting from here, if the yield drops by 1%, I gain 37.17. But if the yield raises by 1%, I only lose 35.46. And that's because of the convexity of the curve. Okay. With a straight line, these would both be the same. So this convex property actually is working to the advantage of the investors. Now, if you really want to get carried away, like calculus carried away, this first derivative of this curve is negative and the second is positive. That's what convexity actually means. So this is one of the unique features of the price yield curve. All right, anyway, so that's that. Now, what happens though, if, as is usually the case, our coupons are paid semi-annually? That means there will be twice as many coupons paid twice as frequently over the same time frame. We have to be careful though. And by the way, the prices will be different. not much. When coupons are paid semi-annually, than when they are paid annually. We're going to find out in a second how much of a difference it makes. So if you go back to our Excel spreadsheet, what I've done here is I've directly below each one of these, I've got the semi-annual case. Oh, wait, maybe not. What is this? No, I guess this is a different case. All right, so it's not the same example. I just wanted you to see this new version. Here's here's a new bond that has 6 years to maturity. The annual coupon is $60. The yield is 4%. So let's price it the old-fashioned way, meaning $60 divided by 1 plus the yield raised to this power. Drag it down, add it up, or you can hit this little sum button if you want. And if you use Excel's version, you'll get the same thing. The rate is here. The number of periods is here. The payment is here. All right. So what I'd like to do is show you how you would have to make adjustments. If, let's say, now suddenly the bond is a semi-annual. Let's say the issuer says, we decided that from now on, all the cash flows will be semi-annual. So first of all, instead of 6 years, we've got 12 semi-annual periods. And secondly, the coupons, instead of $60 every year, are $30 every 6 months. And finally, the yield refers to a 6-month period. So instead of 4% per year, it's quoted as 2% per period. Okay. So, but the calculations are the same. You've got this cash flow divided by 1 plus the semi-annual yield. The exponent is the number of semi-annual periods in the future. This, by the way, this should have been changed to periods. I just noticed that now. We're going to drag it down. And we're going to see how much of a difference it made. Oh yeah, like less than $1. This part doesn't change. PV, the rate is 2. Number of pairs is 12. Payment is 30. So that did cause the price to go up slightly. Now, here in this case, it's the same setup, except that the yield goes from 4% on an annual basis to 8. So if I raise the yield to 8, of course, that means the price of the bond will go down. So B36 is the cash flow, C33 is the yield, A36 is the time frame. I need the sum. And as I predicted, it went down quite a bit. But that's because the yield went up 4 full percentage points. 1104 down to about 907. That's a big difference. Now, if I suddenly change this to a semi-annual bond, um, like before, the coupons are being cut in half, but so is the yield. And there's twice as many cash flows. Okay, so, and now this time, by the way, what's interesting is that this time the semi-annual feature actually lowered the price. Sometimes it goes up, sometimes it goes down. So again, we'll use Excel's built-in functionality, PV. The rate is the 4. Uh, the number of periods is 12 this time, 12 semi-annual periods. The payment is $30 and it's $1,000. All right. Now there's one more case on this page that I want you to see. And that is, it's the same bond, but now the yields are 6 and 3. Okay. So let's start by calculating these present values. Here's my exponent. Here's the sum. This time it's $1,000 even. So we'll do it again with Excel's built-in function, PV. And you'll see they always agree with each other, unless you did something wrong, of course. And now over here, same thing. It's now a semi-annual bond. I'll calculate each individual present value. $30 divided by 1 plus the yield. The exponent is the year, actually the period. All right, I don't know what happened there. It's this divided by 1 plus the yield. Oh, we don't want this here. So the sum is what we're looking for. This is the bond's price. Ah, 1,000. And then we'll use Excel's built-in functionality. The rate, periods. Oh, I see. There was one special case I saved for last. This is the case of a zero coupon bond. This is actually a treasury bill. Okay, I want you to see what happens with a case like this. There is only one cash flow, and that is the bond's face value. In this case, it's 1 year in the future. There are no coupons. It's a very interesting case. So that means the price is simply the present value of the bond's face value. So in this case, I'm paying approximately 925. Actually, yeah, that's right. And you can still use Excel's built-in functionality. The rate is 8, number of periods is 1, but now the payment is 0. You have to watch out for that. And the face value is 1,000. So that means if I buy this bond right now, I pay 925.93, and in a year I get $1,000. Okay. So the rate of return will be my capital gain, which is the difference between the 1,000 and the price, divided by the price, and it is 8%. Beautiful. By the way, I'm going to post this here. I've changed the name slightly. It says Excel template with solutions. So that way, if you miss something, you can go back and look at what I've done after the fact. You like imagine you like miss something, or let's say came home late from work or something. It doesn't matter. I'll be posting this on Brightspace with everything else. Now, here's an interesting twist. Given this price yield curve, what we've been doing up to this point is saying, well, listen, here's my yield. Let's say it's 6, and the bond's price I'll figure it out to be, let's say, 950. But I can go both directions. I can say, well, if I had a bond with a price of 980, what does that suggest about its yield? So I can now flip this all around and say, all right, given a price, I should be able to calculate the bond's yield. So we're going to do that on the next sheet. So we've got these two cases. We have a $50 coupon bond, that's 10 years. And actually, what's separating these three is here, the price of the bond is 950. Here, the price of the bond is 1,000. And here, the bond's price is 1050. Okay, so what's the yield? Now, for this, we need a special function in Excel. We cannot do this algebraically. And so that is called IRR. It's very easy. Just give all the cash flows, and there's your yield. It's so simple. I like simplicity. It's literally IRR stands for internal rate of return. The yield to maturity is itself a special type of internal rate of return. Now, here's the great thing about this. Because all the cash flows are set up the same way, I don't even have to type this thing more than once. I can literally just copy this and paste it over here. And I'll do the same thing for the last one. And then we're going to create another chart. And so once again, I just want to make sure I'm being consistent with this one. Oh, there it is. Okay, price yield. All right, good. So I'm just going to copy them. I know that the yields are different. So the price is 950, 1,000, and whoops, and 1050. I'm just going to copy the yields. You're going to notice something interesting. Just like before, the prices and yields go in opposite directions. Okay, so this is what you would normally expect to see. This is the relationship between prices and yields. Low price is high yield, high price, low yield. What's different here is that we're starting with a price and we're calculating the yield instead of the other way around. Before, we were given a yield and we're asked to calculate the price. Wow, so that was a lot of good practice here. Now, there's plenty of other things we could do here, but I think we have now a basic understanding of the relationship between bond prices and yields, and you can see that they do go in opposite directions. Okay, so let's see what we have now. All right, so there's a few other types of debts that you might run into. Bonds can be structured in so many different ways. We have, for example, structured notes, which is basically a bond where the interest payments and principal are not tied are not set in advance, but they're tied to different variables in the economy. So it's kind of a good way to gamble with your money. If you have a structured note and let's say it's tied to GDP, if GDP growth is faster than anyone thought, you could actually do very well, but you could also end up losing a lot of money if the economy doesn't do so well. Exchange traded notes, there might be a bond whose coupons are tied to the Standard & Poor's 500, for example. Again, this is the kind of thing you might do if you want to gamble, but you wouldn't do this for your retirement. Auction rate securities, where all these, by the way, all these treasury bonds are the way they are actually sold to the public is that the Treasury actually carries out an auction, and the primary bond dealers bid on them, and so whoever has the highest bids gets to have the bonds to sell to their customers. So anyway, but there's so many others. We're just scratching the surface here. The bond markets are really one of the more interesting financial markets out there, and they really are very quantitative. People who work in this area have to have pretty good math skills for the most part. So anyway, so now what are you going to be doing? Well, your assignment asks you to pretty much do exactly what we did tonight, except these are slightly different examples. You've got, in this first sheet, you've got 3 bonds, and you're being asked to calculate the cash flows and the present values so that you can figure out the bond's price by simply adding them up. On sheet 2, it's been changed so that these are now semi-annual bonds. And in sheet 3, you've got a couple of 0 coupon bonds. So this is exactly what we're doing tonight. So you should have absolutely no trouble with these whatsoever. Okay, just follow along what we were doing tonight and you'll be all set. Okay, so these you can work on them and send them to me my email. You won't be able to use these with the MindTap system, but you can just use the old-fashioned approach of emails, all right, or the somewhat old-fashioned approach. I don't know if that qualifies as old-fashioned yet. How many years does it take for something as old-fashioned, do you think? I don't know, but I don't think we got there yet. I'm thinking a previous century, yeah, that's old-fashioned. That's as far back. You need some real time there before something is old-fashioned. But so because all day long I have undergraduate students who are like 18, 19 years old, and sometimes I forget when things were invented or introduced into the market. All I have to do is ask them if they ever heard of this or they ever heard of that, or if they can ever remember a time when this didn't exist. And then I can find out roughly how old something is. They I guess they're aware of the fact that the internet hasn't been around forever, but they've never experienced a day like that. It's always been there for them. It's like the most natural thing in the world. But one, I mentioned one time that, there was back in the day, I guess, there was no internet, there was no laptops, there was no cell phone. I mean, wow, what did people do with themselves all day? It staggers the mind to think about it. But anyway, so that's our discussion about bonds. Now, what's coming after this is sort of we're taking this to a slightly different level. We're going to be asking ourselves about risk in the bond markets, not credit risk. That's a different thing. But instead, let me get to I'm looking around for bright space. Here it is. So this one also has Excel. I'm not sure we're going to have time to do this tonight, but I want to at least start this discussion because here what we're considering is the notion of risk with the bond market. And when I say risk, I mean market risk, the risk that the values of our bonds will fluctuate when interest rates change in the economy. Credit risk is kind of a different type of risk. It's credit risk, you just are worried about whether or not the issuer will make the payments on time. That's a very different thing than market risk, where the market prices can fluctuate over time. So here we're going to focus all our attention on market risk. So the logic behind this discussion is that, as we saw before, when yields in the economy change, so do the prices of our bonds. So if you have a huge portfolio of bonds, the last thing in the world you want to see is rising interest rates because that will lower the value of your bonds. Okay. Um, so we're going to discuss the risks that are facing bond issuers, investors, but also two numerical measures that will make it possible to compare the risk of different bonds on a side-by-side basis. So, it's easy to say, well, this bond maybe is riskier than that one, but you'd like to have numbers you can point to and say, well, this bond is somewhat riskier than this bond, and because they all have a single number or a couple of numbers that you can look at and make that comparison. Just like, it's easy to tell what things are more expensive than other things because the price is higher. It's that simple. So typically, all the securities in the marketplace usually have some type of risk measures associated with them that will enable us to do this kind of comparison. So, like we remember this example. We priced bonds by taking the present value of their future cash flows. So let's see. So let's go back to our spreadsheet for a second. And of course, the first thing we did was we had an example with a bond, 4 years, $40 coupons, and here's the yield to maturity. So the value of the bond is determined by the present value of those cash flows. Now, this formula, what this is trying to do, it's a compact way of saying that C, by the way, is the coupon payment. In fact, I'm going to copy this into my notes here real fast. It's being stubborn. What a shocker. It's being stubborn. There we go. Oh, that's not where it works. Hmm. So the notation here is C is coupon. Now the coupons are fixed. I'll write this now because the coupons can be yearly or semi-annually. I'll just call it a periodic coupon. You notice the coupons are all equal to each other. They never change. They can be treated as a constant. Now F is the face value. Now this symbol, something we've seen before, I'm guessing. Is known in math as the summation operator. This means we're being told to add something up. And there's usually an index attached to it. For example, you might see something like this. And there's going to be some variable, let's say, indexed by I. It's a very compact way of telling us to add up a series of variables whose indices, in this case, range from 1 to n. So by using it here, what this is telling me that I'm doing here is, and oh, by the way, K is the bond yield to maturity. This is the sum of the present values of the bonds coupons. So in other words, it's saying take all the present values and add them up. Okay. Now the face value is only paid back once, so there's no summation operator there. This is a single payment. So this represents the present value of the bonds. So the sum of those two terms is the bond's price. So the sum of let's say the present values of the bond's coupons and the present value of face value give us the bond's price. Okay, so we already did that in Excel. We did a few examples by hand, so intuitively we know that this is right. Okay, so this is the general formula for pricing a bond. No matter how many coupons there are, we calculate all their present values, add them up, and then at the end we calculate the present value, the face value, which is received at the end of the lifetime of the bond, and that adds up to the bond's price. Now, this formula can be used whether the coupons are annual or semi-annual, it doesn't really matter. It's a general all-purpose formula. It's always going to work. All right, so we kind of already did some of these examples. And we also saw what happens when the yields change. So we've already become very familiar with this. Now, one thing I kind of mentioned it earlier, the price, if you look at this spreadsheet, the price yield curve is, I guess, where we should be looking. There's a couple of one thing we do want to notice here. Here, the yield is below the coupon rate. And that means, if you notice, the price is greater than face value. Actually, let me do this a little differently. That's meant to be the implication sign, by the way. Okay. When the yield is exactly equal to the coupon rate, that implies that the bond's price will exactly match the face value. And finally, when the yield is greater, all right, it's trying to be helpful here. Then the coupon rate, the price is now less than the face value. Okay, just so you notice that, like with the low yield, the price goes above the face value. When the yield matches the coupon rate, this will be exactly the face value. And when the yield is higher than the coupon rate, that means the price will be lower than the face value. Now, the reason for that is because with a low coupon rate, low yield rather, um, the well, actually, let me just take a step back here. No matter what the market price of the bond is, the investor will only receive its value at maturity. So if you look at this first case, if I buy the bond here with a low yield and high price, the investor will suffer a capital loss when the bond is redeemed This reduces the return or yield below the coupon rate. That's why, because yes, you're getting a nice 4% coupon, but you're also going to have a capital loss at the maturity date. And so the return or yield is dropped down to 3 from 4% because of that capital loss. But with the high yield, low price, investor will earn a capital gain when the bond is redeemed at maturity. This increases the return or yield above the coupon. But with a yield equal to the coupon rate and a price equal to the face value, the investor will not see capital gain or loss. So the yield will match the coupon rate. Now, I don't know if they're going to ask you about this in MindTap. I'm not sure how sophisticated the questions are, but if they do, you've got it all right here. Okay, it's possible, I guess, they might bring this up. And so it would be right here. This discussion here is the sort of our interpretation of the results that we obtain when we did all pricing of this bond. Okay, so this is the economic logic behind what we're seeing here. Anyway, and we already know there's an inverse relationship when rates go up, bond prices fall, and vice versa, because the present values fluctuate. Okay, so by the way, when we find a bond in the marketplace that's selling for less than its face value, we sometimes see it called a discount bond. If it has the same price as the face value, it's often called a par bond. And then if it's selling for more than its market price, its face value rather, we often call it a premium bond. So this terminology simply tells us where the price is relative to the bond's face value. So back here in these examples, this is a par bond, this is a discount bond, and this is a premium bond. It's just terminology. It's not that important. And of course, we've already seen, now here is more detail about how to do this in Excel. In case you forget, here's the function that you can use. This is the one that is used instead of calculating all the present values and adding them up. This is the one that can be done all in one shot, which is kind of nice. But it only works because the coupons are all the same. If they weren't, then you would still have to do all the individual present values and add them up. That's one of the nice things about bonds. Okay. All right. So, um, this is exactly what I did in the spreadsheet. If you come back there and look at this, you'll notice the second price was done with the Excel command. The negative is there just because Excel will make it negative if you don't do that. The logic being that this is how much you're paying for the bond, therefore it should be a negative number. If you don't want to see negatives, just put a negative out there. Okay, so we've done these. We've already figured out how to adjust for semi-annual coupons. We have to use half the annual yield or interest rate. We doubled the number of periods and we cut the coupons in half. Okay, then we'll get the correct prices. And so actually, I recognize this example now. This is what we are doing on the second sheet here. Or not the second sheet, but down here below. These are the examples with semi-annual bonds. That's important because most of the bonds in the United States do in fact make semi-annual payments. Uh, it's kind of unusual to find them, the ones that don't. It's just, it's a market convention. I'm not sure how this came about. In fact, I don't know, maybe Investopedia has some thoughts about that. Let's check this out. If not, maybe ChatGPT knows. You see how in this day and age, we've got to check out all of our sources. Because you know the underwriters are intimately familiar with this stuff. See, now this is what I mean. This is what like Google. Oh my God. I don't know. Do I actually even have access? I don't know how it works. First of all, let me ask one question without paying for it. Anyone out there know how to use this stuff? I don't. Oh, right here. Why do US bonds make semi-annual coupons? Wait a minute. What happened to my question? Oh, here it comes. The semi-annual coupon payment schedule became the standard in the US market over time due to customs. Well, you see, no, that's not that how. No. I thought it would go back in time and tell me exactly when this started and why. And oh boy, I'm not that impressed. Oh well, what did we expect? But all right, so later on they'll test it out on something else. So anyway, but because that's the standard in the United States, we do have to be familiar with how to price bonds with semi-annual coupons. All right, so I see we've kind of already done these examples too. Zero coupon bonds, we briefly touched on these. These are the ones that do not provide any coupons. They're sold at a discount to face value. Like we know that the treasury bills that go out to 1 year are sold this way. And this has the advantage to the investors of not having to worry about reinvestment income or reinvestment risk. We have a guaranteed rate of return, basically. And the strips market exists so that we can have longer maturity zero coupon bonds if we want to do that. The word capital gain, by the way, the phrase means that you sell an asset for a higher price than you paid for it. And that has tax implications. The usually capital gains are taxed at a lower rate than current income. So, you know, for certain types of strategies, this is done deliberately to look for capital gains instead of current income. So the zero coupon bond, if you remember, the price for any bond, let's go back to the beginning here. We went through and calculated all these present values. Yeah, here it is. I just want you to see these side by side. And then so we can see the difference. So, you know, the one on the top is for coupon bonds, the one on the bottom is for zeros. The difference between the two is that down here, C equals zero. So the formula reduces to a single term, one payment only. That's it. With a zero coupon bond, you're getting one payment at maturity. That's it. And so all of these drop out here, and you're left with a very simple formula. Okay, so for example, if you had $1,000 face value zero with an 8% yield, that means today you would expect to pay 925.93 for it. Wow. And so, these are typically short term, except for the strips market, which we discussed earlier. Now, here's an oddball situation, a perpetuity. These have occasionally been issued throughout history. A perpetuity is a bond where instead of getting a fixed stream of coupon payments and then repayment of principal, what they're doing instead is saying, well, listen, we're going to give you coupon payments forever, but you'll never get your face value back. Huh, interesting. The British government issued these during the Napoleonic Wars. Um, I can't think of any other examples, but you're just paying for an infinite stream of coupon payments. And so the price is simple. It's C, the coupon payment over the yield. Huh, wow. So, so how is this possible? Well, let's see. So what's basically happening is n is converging to infinity. And so the present values, well, actually, it's going to be more complicated than that just to prove it. But what's happening is the present values of the very distant cash flows are getting very close to zero. And there is no F, by the way. This term drops out. So we don't want to get overly technical. This is actually a geometric series, though, so we're not going to get too deeply involved with this, but that's what's actually happening. If we have an infinite number of these, then it reduces to C over K. So for example, if the annual coupon is 50 and the appropriate yield or discount rate is 5%, you'd be expected to pay $1,000 for this perpetuity. Huh. Sometimes a bond with an infinite lifetime like this is called a console. So now let's see if ChatGPT has a good knowledge of history. Hmm. Well, they this time they did a good job. Wow, how do you like that? Because they didn't think they could repay the principal when it came due. That's what they were concerned about. So I guess they figured, well, what the heck? Everyone's in a patriotic mood. Let's see if they're willing to buy these consoles. I'm glad. Maybe I'll lean on this thing more often in the future. Of course, this chat GPT thing can allegedly write term papers and it can write music and it can create poetry and it can supposedly do anything that human beings can do. So we have to keep an eye on this thing. But it's like a tool that we can use, but we don't want to let it get out of hand. Um, but yeah, I mean, for some things, it can be very helpful because if you notice, if you go to like Investopedia, you might get lucky and find the right article, but By doing it this way, you can sort of focus your question and ask it. I want to know the reason behind this. I want to know why this is happening. I just don't want to know the dates. I think that's where its advantage is going to be very helpful. You can sort of tailor your questions to what you really want to know, as opposed to what's already out there in the internet. Now, I have no idea how they cobbled this information together so fast, but there it is. And I'm not going to say no to that. So I think I'm going to ask it if it's going to rain tomorrow. No, no, no. Let's not tease it. Um, it'll probably come back and say, I have no idea. But all right, anyway, so I think, ooh, God, we're having so much fun. It's already 8 o'clock. All right. So now what we're going to start doing here is starting to try to explain how, you know, what's causing, the fluctuations in bond prices in terms of economics. So I think we can knock this off for a bit. When we come back after the break around 8:30ish, we'll start to take a deeper look at the economics behind all of this. Okay. All right. So let's stop for a while and I'll see you in a bit. Okay, so now we can take a look at some of the economic rationale behind what we're doing. So we already know that bond prices and interest rates go in opposite directions. So that means that bond prices will be directly impacted by the factors that in turn affect the yields on treasury securities. Okay, so for example, interest rates can fluctuate in response to changes in inflationary expectations, economic growth, money supply, budget deficits, et cetera, et cetera. Typically, inflationary expectations, as they go up, so do interest rates in the economy. Economic growth tends to cause rates to rise too, as the demand for loanable funds goes up. The money supply growth, in the short run at least, that has a tendency to lower interest rates. And when interest rates are falling, of course, growth expands and eventually interest rates start to rise again. But in the very short run, higher money supply growth will tend to be matched by lower interest rates. In fact, this is the reason why the Fed increases the money supply when they want to stimulate the economy, because the point of it is to lower interest rates, which in turn should stimulate spending by consumers and investment spending by corporations. Budget deficits do also have an impact, although it's more of a long run impact. As the government keeps getting deeper and deeper into debt, people start to wonder, how long can we continue to finance this? And then interest rates will tend to climb when deficits rise. So expectations, now a lot of economic behavior is driven by expectations. We tend to react to what we think will happen in the future. So if you're worried about higher inflation in the future, um, then you may decide to invest in assets that provide a higher real rate of return. You may decide to borrow funds now before interest rates go up, for example. So um, when inflation is very low, people aren't terribly worried about it. So it may not have that big of an impact on people's daily lives. But when inflation gets to what are considered to be relatively high levels, that's when people start taking it into account when they make decisions. So higher inflation tends to be matched by people being more careful and paying closer attention to inflation and trying to and take steps to avoid being burned by it in the future, so to speak. So anyway, so inflation, everyone's aware of it, but it's not people's top priority to worry about it unless it reaches fairly high levels by historical standards. Now, if of course, if we expect inflation to be even lower in the future, then rates have a tendency to fall. But when people are worried about inflation, then you tend to see higher rates, and you also tend to see a steeper yield curve. Now, economic growth, of course, is good for everyone. When the economy is growing, that means everybody's optimistic, people's incomes are growing, they're more likely to want to borrow and save, or sorry, borrow and then invest. They may be more willing to buy expensive items like housing, cars, and computers, maybe. So a strong growing economy tends to lead to higher interest rates because there's an increased demand for loanable funds. And the supply of loanable funds doesn't change very quickly. So when the demand for loanable funds goes up, then that tends to be matched by higher interest rates, at least in the short run. In the long run, if investments, let's say people save more or the government somehow manages to lower its deficits, then you might see lower interest rates as a result. But in the short run, um, the supply of loanable funds is not doesn't change that quickly. So when there's an increase in the demand for loanable funds, this with a relatively fixed supply, then higher demand for loanable funds typically results in higher interest rates. Now, we talked about the money supply in the past. The money supply um, I mean, for the most part, when we talk about the money supply, we're thinking about M1, which is currency in circulation plus checking deposits. Now, it's getting to the point, though, where it's becoming more and more difficult for the Federal Reserve to measure the money supply, much less control it, because of the technology that makes it possible to pay for things with all sorts of different methods, like swiping your phone over, the reader and that type of thing. But the Fed can have an effect on the monetary base, and the monetary base is indirectly related to the money supply. So if the Fed believes that inflation is rising, they will do what they have to do to slow down the growth of the money supply, and vice versa. Okay, so in other words, if the economy is struggling, they'll tend to increase the money supply, and that will lower interest rates so that, of course, that means people are more likely to buy, to borrow money, and businesses are more likely to invest. Rising future inflation. Yeah, if we're convinced that inflation is going up, um, well, like I said, it only stands to reason that if you had thought about buying a car, you're going to try to buy it now before interest rates go up. So in other words, people might borrow now because they expect interest rates to be higher in the future, and that becomes like a self-fulfilling prophecy that if people behave this way, interest rates will actually start to go up, even if there was no reason in the first place. Meaning that sometimes economic variables change simply because people expect them to. Budget deficits, it's getting to the point where, they're always huge. I don't think people think about them excessively. They expect to have huge deficits, and of course, we always have huge deficits, unless they really start to get to realistic, ridiculously high levels. Um, I don't think people are paying a huge amount of attention to budget deficits, but at the same time, though, that of course can only lead to one thing, and that's higher interest rates in the future. Now, as far as credit risk goes, credit risk, of course, specifically means the risk that a borrower will not be able to repay their loans in a timely manner. Okay, so we tend to keep this separate from market risk. Market risk is where the owners of bonds might lose um, or suffer capital losses if interest rates go up. Credit risk is the risk that you might actually take a huge loss if the issuer of your bond is suddenly unable to make the payments that were promised in the first place. So that's a huge deal. I mean, if there isn't a credit event with your bond, you're probably going to end up losing a pretty significant amount of your investment. So, this is awfully important for investors to keep an eye on. And this is, of course, one of the reasons why the ratings from Standard & Poor's and Moody's are so important. Now, of course, credit risk is also affected by many different economic variables. Economic growth, the faster the economy is growing, the less likely companies are to go out of business. The maturity of debt, debt that's due very soon. Well, realistically, the sooner debt is due, the less likely a borrower is going to be able to meet the deadline. And of course, the characteristics of the debt issuers themselves. If corporations are taking on a lot of debt by issuing bonds, that's going to make them riskier. Or on the other hand, if they're growing faster than expected, that makes them less risky. So there's a lot of variables here that also directly impact on credit risk. For example, we know that stronger growth means that companies are doing better, and that greatly reduces the risk of bankruptcy. It also helps the government because tax revenues go up when the economy is growing. And of course, profits usually rise when the economy is growing. Although some companies are more impacted by the business cycle than others. For certain types of products, like Procter and Gamble is a good example of this. They make the types of products that people buy no matter what the state of the economy is. Like if we went to a page that shows all the products that they make, you'll see what I mean. Okay, what products do they have? Mr. Clean, all right. Clorox bleach, Charmin toilet paper, Bounty paper towels. I mean, these are the kinds of things you need. You're not going to stop buying paper towels just because the economy isn't doing well. So, OxyClean, You get the picture. These are the things that people must have in their daily lives. So, the earnings of a company like Procter and Gamble are not going to be terribly affected if the economy slides into recession. It's not helping, but the bottom line is people need these products and they're going to pay for them whether or not the economy is in recession. Okay? Nobody's going to stop cleaning their house because there's a recession going on. Let's put it that way. But then there's other companies that sell, let's say, luxury items, where the state of the economy is going to have a major impact on their sales. I would say, for example, a company like Tesla, um, their cars are very expensive. And I would imagine that when the economy is sluggish, people are less likely to buy a new Tesla because it's so expensive. Um, you can always hang on to your old car for another year. You have to, but you've got to clean your house now. So therefore, a company like Procter and Gamble is less directly affected by economic growth, but still, all at some point, all companies are ultimately impacted by the state of the economy. Slowing growth, when the economy is not actually in recession, but the growth rate is pretty slow, um, that's going to, of course, impact many different corporations, raising the risk of default. Characteristics of debt issuers. Now, when you look at, if you actually were subscribing to Standard and Poor's, let's say, and you were looking at the ratings, they're going to give you a lot of detailed information about why they've chosen this rating for the company. There's a lot of factors that are taken into account. And so, they'll look at the company's balance sheet and their income statement, and they'll look at the products that they produce and the markets in which they sell them. And what they're trying to do is come up with a formula that says, listen, here is what we think is the likelihood that this company will go bankrupt or run out of money. It might be possible to look at a list somewhere. Let's see what we can do. In fact, maybe our friend ChatGPT can help us with this. Where did it go? All right, let's try that. So we want to know, um, can't figure out where to put my question. Oh, they're trying to sell it. That's why. Oh boy. All right. Oh, okay. Oh no, I must have asked it too many questions. Well, you know what? I think we can probably find an article on Investopedia about this. Let's see. Let's try this article by Forbes. So there's a chart of the different. You see, they're all somewhat similar to each other. It's, um, it's just a brief overview of the ratings. I thought that, well, here, this one says key factors. Here we go. Um, a primary consideration is the issuer's financial health. looking at their balance sheet, income statement, cash flow statement. These documents reveal the issuer's ability to meet debt obligations. And if you've had an accounting course, liquidity ratios, which tell us how easily we can raise funds in the short run, leverage ratios, which explain how much debt we have relative to our equity, profitability, like return on equity. So, for example, a company with a strong cash flow and low debt levels is generally seen as less risky than one with, high debt levels. The industry itself, of course, has a huge impact on the credit risk of a corporation. As we were discussing a minute ago, some industries are more volatile or susceptible to the business cycle. Um, for example, companies in the technology sector may face rapid demands, whereas utility companies have more stable demand. And these are all taken into account when they create bond ratings. Inflation, interest rates, fiscal policy are pivotal factors that can sway bond ratings. Rising inflation erodes the purchasing power of bonds, fixed income returns, or bonds, prompting investors to demand higher yields, which can affect existing bonds. Changes in interest rates directly impact the cost of borrowing. Higher interest rates from the Fed can affect an issuer's debt servicing costs. Um, Fiscal policies, government spending, taxation, geopolitical events, et cetera, et cetera. All right, well, that was pretty good. Maturity of debt. Um, well, the thing about debt is like, a lot of corporate bonds, the maturity is way, way, way out in the future, 10, 20, 30 years. Who knows what's going to happen down the road like that? So, investors in longer term debt expect to be compensated for holding such long-term debt because even the smallest changes in interest rates can have a huge impact on the prices of long-term bonds. Okay, like if you just go back and look at a lot of the calculations we're just doing, um, I just want to briefly mention here that the impact of a change in interest rates on a bond's price will be greater for longer maturity bonds and shorter maturity bonds. Okay, so imagine you've got two zero coupon bonds. All right. Suppose that there are two zero bonds. They sell 1,000 on yield of 5%. Um, First bond has maturity of 1 year, and the second has maturity 3 years. What happens to the prices of these bonds if the yield rises to 6%, let's say? All right, so for the first bond, we call bond one, the price originally was 1,000 over 1.05 to the first power, and that would be now 52.38, and then a yield of 6, and drops to 943.40, and the percentage change there 943.40 minus 938 all over 952.38 equals it's a loss of about 0.009. -0.9%. So it's less than a percent. Now let's do the same experiment for bond two. Initially, the price was, let's see, 231.30. And now, after the increase in yields, it goes down to 174.11. Now, what kind of percentage changes that? Well, I'm going to go out and let it say it's a much larger number. Oh my God, 24.8%. Well, now, of course, I do want to point out, though, that cuts both ways. In other words, if yields were to drop, um, I'll make a little note here. Yields drop, second bond has a much larger rate of return. Uh, the percentage increase, let's put it that way, for the second bond is much larger than the first bond. So it cuts both ways, right? So in other words, if rates are going up, the long-term bond is the one that's going to lose the most money. But if rates are heading down, then it's the one that's going to make the most money. At least it's a percentage. Now, what this indicates, though, is that in general, the price of the 30-year bond is more volatile than the 1-year. So as a result, all other things being equal, 30-year bond is considered riskier than the. Therefore, investors usually acquire premium, higher return, best in longer term bonds. And this is why the yield curve usually is facing up. Um, Not always, other factors can get involved, but I mentioned this a few times. The yield curve in the treasury market usually is upward sloping for that reason, because people are concerned about the risk of the 30-year bonds compared to 1-year treasury bills. So the maturity can have a pretty significant impact on the risk of a bond, and therefore the kind of yield that you can expect to earn from it. By the way, we're going to see later on, let's save that for later. Measures that we can define that will help us compare these different bonds on a side-by-side basis, just to determine which ones are the most sensitive to changes in interest rates, because that's a huge deal to a bond investor or a professional portfolio manager who's responsible for, let's say, his company's fixed income portfolios. All right. Now, speak of the devil, here are the measures I was about to mention: bond price elasticity and duration. Now, just as a side note, the word elasticity in economics refers to how sensitive one variable is to changes in another. So the classic example of this is price elasticity of demand, which, if you've had microeconomics, you know what this is. This refers to the percentage change in the quantity demand of a good that results from a specified change in the price. For example, if the price of bread, let's say, rises by 1% and the quantity demanded falls by 5%, the last price elasticity demand is negative 0.5. But on the other hand, of course, bread is stable, so you expect people they'll buy less bread, but not that much less. Um, but on the other hand, if the price of, let's say, Broadway tickets, oh, I like that because that I think anyone realize that's a luxury item. Rises by 1% and the quantity demanded falls by 2%. Then the price elasticity of demand or is -2. So words, Broadway tickets are seen as a luxury, and therefore their price elasticity is greater than for bread, which is seen as a necessity. You gotta eat. You don't have to go to a show, but you have to eat. Okay. So this is a classic example of what the word elasticity means in economics. How sensitive is one variable to changes in another variable? There are going to be all kinds of different types of elasticities. Um, but what we're specifically interested in here is the percentage change in the price of a bond due to a given change in the yield, percentage change. Okay. So here's an example. I worked this out in advance for us. A 20-year bond has an annual coupon of $40 and a face value of 1,000. The yield to maturity is 5%, and at that yield, the price is 875.38. So we did that calculation with the present value. We took this into Excel and calculated its price. So yield rises to 6%. We know the price is going to drop. The question is how much. So if we did the new calculations, you'd see that the new price is 770.60. And that means that the price elasticity is, okay, and that's negative 11.969%. The yield, on the other hand, is 20%. So in other words, the percentage change in the bond's price is a loss of 11.969%. The percentage change in the yield is 20%. It went up 20%. So the ratio of these two is what we're trying to get at. The percentage change in the price is negative 11.969. The gain in the yield is 20. That leaves me with an elasticity of negative 0.59846. Or you can think of it as for every 1% change in the yield, there's a 0.59846% change in the price. Now, if we could find another bond, let's say the higher is the bond price elasticity, the more sensitive bond is changes in interest rates. So like in this case, even though it's a negative number, we want to think in terms of absolute value. So in other words, if a bond's price elasticity is negative 0.59, Um, and another, well, let's say that, let's call it bond, just to make it clear, let's say bond one and bond two is negative 0.8. Then bond two is more sensitive to yield changes than bond one. Even though mathematically negative 0.8 is actually a smaller number. So in other words, you have to, in terms of absolute values, the magnitude of this number is what determines the sensitivity of the bond's price to changes. In other words, you can almost even ignore the negative part. It's understood that it's negative. So the larger the number itself, the more sensitive the bond's price is to changes in yields. Now that'll help determine your strategy. So if yields are expected to rise, investors will prefer low elasticity bonds. And if yields are expected to fall, investors will prefer high elasticity bonds. Okay. In the first case, higher yields means a lower price. So you want the bonds that don't fall quite so much. In the second case, if yields go up, down rather, the price will go up. So you want the very sensitive bonds because they'll gain more than the less sensitive ones. So, if you could imagine that as a bond owner or as a bond portfolio manager, you're going to constantly be watching the news. Need to pay close attention to market conditions to determine if interest rates are likely to rise or fall in the future. So you know that if you're a bond portfolio manager, you've got your eye on the news constantly. You want to know what's happening out there to determine if rates are heading up, if they're heading down, to help you decide what your strategy is. Now, having said that, here's a little side note though. Bonds are typically seen as very long-term investments. What that means is that if a bond is held to maturity, the investor will receive the full face value. And all the coupons, regardless of the conditions. So in other words, if you really hold the bond all the way through, you're going to end up with the cash flows that you're expecting. It's when we have to sell the bonds prior to the maturity date. As fluctuations only affect investors that sell bonds prior to the maturity date. So the long-term investors, you almost can ignore this stuff. I mean, if you bought a 30-year bond and you're expecting to retire in 30 years, unless there's a default, you're all set. You're going to get whatever you're expecting. It's just that if you have to sell it in 10 years, then you don't know what's going to happen. If rates have gone up in the meantime, you can end up with a loss. So that's where the real risk comes in. The fact that you might have to sell a bond prior to the maturity date. And then at that time, it's hard to tell today what the price is likely to be. But it's possible to get around all this by simply holding the bond to the maturity date. Okay. So bonds, yeah, and in practice, except for treasuries, bonds don't trade very often. Most investors buy bonds, the intention of holding them for long periods of time. It's not like stocks. People buy and sell them all the time. You get tired of the stock, you get worried about it, you sell it. Okay. Or you get optimistic about a stock, you buy it. Bonds, you can just buy it and say, all right, I've got this AT&T bond in my portfolio, it matures in 10 years. What would be the point of selling it? I'll just hang on to it, unless the coupons are ridiculous low. So they don't trade a whole lot. And in fact, like I was saying before, um, financial institutions often hold bonds because they are considered to be less risky than stocks. You see this happen before. I mean, sometimes the market's in a difficult place. Stocks could lose enormous amounts of money in very short periods of time. You don't want to see that with bonds. Prices tend to be fairly stable. Um, but like a stock could lose half of its value overnight if there's the wrong things are happening in the market. And so stocks can suddenly plunge where you're not likely to see that with bonds. By the way, so what is it that's driving this? Well, just in general, um, bonds price elasticity increases with its maturity and decreases. Now, this is one that's hard to explain or visualize why, but decreases with the size of the coupon. In other words, um, zero coupon bonds are the riskiest, and high coupon bonds are the safest. All other things being equal. But in general, the one factor you need to consider probably more than the coupons is the length of the maturity date. The further out in the future the bond matures, the more sensitive it will be to changes. As we saw with my example here with bond one and bond two. Bond one is only 1 year bond, bond two is a 30-year bond. They both have the same coupon. So in other words, otherwise we're mixing apples and oranges. You can see it was quite a big difference in the price sensitivity. The percentage here, like I said, is only about half of 1%, really. Not even, but here it's like 24%. I mean, that's a big difference. Okay. Now, here we're going to introduce, now, this is another alternative measure of a bond's price risk. This is a very complex topic, so much so that we're going to need Excel to help us with this. But this is one of the most widely used measures of risk in the bond markets, this notion of duration. Every bond portfolio manager on Wall Street knows the duration of the bonds in his or her portfolio. Investors should too, because it's a very important measure that gives us a very good idea of how much gain or loss result from a given change in yields. So this measure has actually evolved over time. There's a couple of different versions of duration, and we're going to look at where they're coming from and what they're trying to tell us. And then we're going to use Excel to calculate duration for ourselves and understand how it works. But not tonight. We'll have to save this for next time. All right, we got a lot done here. Don't forget about the Excel assignment, by the way. You shouldn't have any trouble because it's exactly like what we did here. But take a look at the spreadsheet that we did. And if you somehow fell behind or you didn't get all the answers, they're right here. I'll be posting them in Brightspace as soon as we're done. And that way you can go back and look at the formulas and remind yourself how this works. And then you should have no trouble doing the assignment. And don't forget, there's a separate tab here for yields and prices. And there's also explanatory notes. So I think you should be all set. All right. So, it looks like, I mean, it's Thursday, so I guess I won't see you again until next Tuesday. So we're flying along here, and I'll see you all next week.
Thanks, Professor. Have a good night.
Yeah. Good night. You know,
Just one question.
sure.
When is this due, this specific Excel?
Oh, tell you what, how about a week from Monday?
A week from Monday?
I didn't
Okay.
even think of, now that you mentioned it. I'll write this down somewhere that I asked for a week from Monday. Because you have to fit the mind tap is really more important, I think. But a week from Monday is the oh God, what day is that? I think that's the 15th, but 16th. All right. So how about that? Let's agree that you'll have that ready by the 16th.
Okay, and you want it submitted through Brightspace?
You could put it in, well, I think it'll be easier to just email it to me. I
Email
know
to you?
there's a
Okay.
way. I know there's a way you can put files into Brightspace. Um, I think. I'll tell you what, I'll leave it up to you. You can either put it in Brightspace. I don't know how that works. That's the problem. I'll
Yeah,
ask.
don't worry about it. Yeah,
Right.
whatever works. Just wanted
Yeah,
to
I
know.
think email will just be that much simpler.
Okay,
All
sounds good.
right. Okay.
Thank you.
All right. I'll see you next
Night.
time. All right. Bye.